From 2020 to 2022, Lulu grew revenue by about 30%. So the interesting part about this growth is that you'd probably assume that Lulu's advertising budget as a percentage of their revenue was a lot higher than some of these other brands, but you'd be wrong on that assumption. So Lulu's advertising expense as a percent of revenue was only 4.6%, and that's versus 8% for Nike, 11% for Under Armour, and about 13% for Adidas.
So this is our third episode we've recorded on the Best Quality Idea series. And for those not familiar, this is where Kyle and I take a look at our portfolios, take a look at our watch list, and find a company that seems to potentially be a good quality opportunity in the market at this time. So for today's episode, we're going to be covering Lululemon, and I'm going to kick off the episode with a brief overview on the company, go a bit on a tangent here, and then I'll throw it over to Kyle and dive into some of the specifics. So Lululemon is quite an interesting company, and I think it comes across many people's screens when they're looking at quality names and companies they're quite familiar with. I'm sure many in the audience are familiar with this brand. So for those who might not be as familiar with them, I'll dive into their background and their founding story and sort of what they do here. They were founded in 1998 in Vancouver, and the company sells athletic apparel. And they really are targeting this yoga niche, but they've also expanded into some other areas. So running, weightlifting, and a lot of other types of workouts you can do. It's really an athletic apparel company. And they've really benefited, in my mind and from my perspective, from this trend to athleisure. So over the years, we've seen this trend towards people really valuing comfort and wearing something that's comfortable yet stylish. And less people are going to the office and wearing a suit or a dress and whatnot. Or, out in public, people wear this type of stuff all the time. So a company like Lululemon has definitely benefited from this trend. And they went public in 2007. At the time of the IPO, the stock was around $12 a share. And at the time of recording, it's around 360. It's been quite volatile lately after their recent earnings release. And that's a compounded annual growth rate in the stock of 22%. And then you look at the top line revenue, 2007, it was $148 million, and that's grown to $9.6 billion. And that's a CAGR, compounded annual growth rate of nearly 28%. And what's also great to see is that essentially all of this growth is entirely organic. So this means that they aren't making a ton of acquisitions along the way to achieve this level of growth. So Lululemon's also a retailer. So they have 711 total stores globally. 367 of them are in the US, 127 in China, around 70 in Canada, 30 in Australia, and then they're in a number of other different countries, to a lesser extent, the UK, South Korea, and some other countries. And they also have a substantial presence online as well. They report their direct-to-consumer revenue, which I just view as the sales they're doing in their e-commerce segment. And one of the first things I like to do when looking at a big brand name company like this is see if any well-known investors own it. So Francois Rochon looks to be the only one that I could find. I was looking at Datarama for some of this data. He has nearly a 3% position in his fund, and he added 1% in Q3 2022 during that pullback. And that looks to be the most recent time he added a sizable stake, according to Datarama. And then according to NASDAQ.com, it looks like he initially added the position in 2017 around $60 a share, but it looks like it was a very small initial position. So I actually had a call with Francois Rochon the other day, and I had asked him about Lulu because I knew we were going to be recording this episode. And I was happy to hear that he was disappointed a bit by the recent quarter they had, but he still believed in the long-term growth trajectory of the business. And I'll also mention that at the time of recording, Kyle and I do not own shares in Lululemon. So zooming back a bit further, the company was initially started by Chip Wilson in 1998. And he really just wanted to create high quality clothing for women in the yoga niche. But now they've expanded into a number of different segments. And digging into Chip's background a bit, it was in 1979 he founded an apparel company called West Beach Snowboard, which Kyle, you're familiar with. And He ended up selling this company in 1997 before starting Lululemon in 1998. So Chip was the CEO of Lululemon until 2005, and over the years, he's become less and less involved in the company. In 2012, he retired from his position as Chief Innovation and Branding Officer, and then in 2015, he stepped down from the board. So Chip really just has developed this passion in apparel, and he actually claims to have invented the vertical retailing niche, and selling clothing through retail stores is just incredibly difficult. And Chip has proven the ability to build a strong, enduring business, and just did a really fantastic job in getting the company off the ground and getting them going. You know, I wish he were still involved with the company, but it is good to see that today he still owns 10.7 million shares. That's about 8.5% of the company, worth over $4 billion. And turning back to the product a bit here, Lululemon is really well known for their yoga pants. I think, you know, many women would say that their pants are definitely comfortable, fashionable, and it's exactly what a lot of women want. And whenever I go to the gym or go out in public, you see women everywhere wearing these. So it's definitely not something people are just wearing to their yoga classes and calling it a day. And Lululemon has certainly helped popularize this trend, and other brands have come out with similar products. You look at Athleta, Nike, other companies releasing very similar products. And I think one important distinction that we're going to be getting into, Kyle, is that companies like Nike focused on these big name athletes, especially Nike and Adidas, you know, athletes like, you think of Michael Jordan, Tiger Woods. Lululemon, they started by partnering more so with everyday people within the yoga niche, and had essentially become partnered with these athletes in the niche to become brand ambassadors. So Lululemon is really differentiating themselves with a community feel as well as a higher quality product. And they needed these ambassadors, you know, to create that community feel and also communicate the benefits of why Lululemon was better or different than the other options on the market. And another interesting stat I found is that Lululemon still today caters very much to women. So brands like Nike and Adidas, they get 2/3 of their revenue from men, whereas Lululemon is the exact opposite. They get 2/3 of their revenue from women. So they're very much targeting a different customer than a lot of these other brands and positioning themselves a little bit differently. And a key theme I continually saw in researching Lululemon is that just their products are definitely higher quality than many of the other brands out there. And Chip believes from the very beginning that if women were just to try on the pants, they would feel the difference. And a lot of people would just be customers for life from there. Who knows necessarily how true that is? You would certainly know better than me, being from Vancouver. And Chip has said that he just wants to dominate the yoga niche, and that sort of develops that customer loyalty and gives them the right to start to expand to other markets and do some cross-selling. So they're definitely at the premium end of the market relative to the other brands. And I think over the years, we've seen a lot of companies start to develop similar offerings. And Lulu has just shown that they can continue to charge higher prices than many of their competitors. And yeah, we can start diving into why that might be.
Yeah, absolutely, Clay. So with Lululemon, it's, you know, its competitive advantage is quite simple. It's the brand, right? Like you said, you know, they have really high quality gear. It's kind of easy to identify when someone's wearing it. And the brand strength that they've built over time is you know, it's showing how powerful it is now. So Hamilton Helmer points out in his book, 7 Powers, that, quote, branding is an asset that communicates information and evokes positive emotions in the customer, leading to an increased willingness to pay for that product. So he further breaks that down into 2 distinct sections, which are 1, effective valence, and 2, uncertainty reduction. So just in case you get confused by those terms, effective valence is what you think about when looking at a popular brand like Coca-Cola. So like, you know, Coca-Cola's entire premise is based on the product evoking a positive emotion from their customers, which is why their advertising has always been kind of geared towards, you know, evoking that positive emotion. So because of the strength of the brand, people are willing to pay more for its products than a competitor because we know specifically what we're going to get when we drink a Coca-Cola. So, for instance, I can go into a Safeway and I can buy Coca-Cola, or I can buy a Compliments branded Coca-Cola. And because Coca-Cola has this brand that is built up now over 100 years, it can charge a higher price than a competitor without losing any market share. So let's loop this back into Lululemon. Lululemon has been around since 1998. So, obviously not quite the same tenure as Coca-Cola, but it's been around for a long time. And the brand is very, very strong. So, it now has about 25 years of existence where it has built its strength inside the mind of its customers. So when we look at what is triggering the positive emotion in customers, I would attribute that to probably, about 4 different things. So 1 is product quality, 2 is customer service, 3 is the first mover advantage and athleisure that you kind of pointed out there. And then 4 is the community-centered marketing. So I own quite a bit of Lululemon, as does a lot of people that I know, because I do live in Vancouver where the company was created. So I had a pretty good view of the popularity of the brand quite early on, but unfortunately I didn't take advantage of that by buying shares. But one of the observations I had on Lululemon basically since day one was its quality. The fabric is super durable and it doesn't break down. I have many shirts that I've owned for an embarrassing long period of time simply because they just maintain themselves. Other shirts like, I love Nike and stuff, but Nike stuff after a long period of time, it just falls apart. And, Lululemon doesn't do that. And and the other thing I also like about it is that, it doesn't get super loose over time. So that's kind of one of the competitive advantages I think the quality of the garments have. So another thing that's cool about Lululemon is their return policy. So just their customer service. So they have this quality promise. Basically, if something happens to your gear that, isn't due to normal wear and tear, you can take it in and they'll repair it for you. So I actually did this. I had a set of pants from them. I had for about 2 years. And eventually I just got a hole in one of my pockets. And to be honest, it's probably my fault. I think it's just my keys in my pocket and just continuously digging into the hole, and it made a hole in the pocket. But I took them back to Lululemon, 0 questions asked. They, gave me a little tag to come and told me they'd fix it. They'd give me a call after a few days and there you go, done. Didn't ask for money. They were really, really helpful. And I really enjoyed that experience. It was zero friction. And then moving on to being at the forefront of the athleisure movement. This is a movement towards wearing clothes that you can go to the gym or, even go out and, look reasonably nice in. So, it's clothes that both are comfortable and look good. And then another superpower of the brand is its ability to simply leverage the community aspect to help increase brand awareness. So Clay kind of touched on this already, how they don't have to pay millions and millions of dollars to all these athletes. They can just use their brand ambassadors to help spread the word. So from 2020 to 2022, Lulu grew revenue by about 30%. And if you compare this to some of the other big names like Adidas, 6%, Nike, 5%, and Under Armour at 2%. So the interesting part about this growth is that you'd probably assume that Lulu's advertising budget as a percentage of their revenue was a lot higher than some of these other brands, but you'd be wrong on that assumption. So Lulu's advertising expense as a percent of revenue was only 4.6%, and that's versus 8% for Nike, 11% for Under Armour, and about 13% for Adidas. So clearly their way of using their community, leveraging their community to sell their product was working really, really well. And it's resulting in all these cost savings that are dropping to the bottom line, which I think helps a lot with the profitability of the business. So kind of jumping into that and looking at some of the ways they keep their costs down is number one, that ambassador program. So I kind of just talked about that, but they basically are partnering with regular people and then just, rewarding them not with money, but with product. And then, these people obviously are well known in their communities, or, they might be yoga instructors or teachers of some sort of physical activity. Their customers or clients see them wearing their gear and they like the way they look at it. They can tell their people about how much they like it and just kind of spread the word, and they get this organic growth from that. And then second, they have these community events. So they have marathons and other events where they have product giveaways as part of their sign up. So I had a good friend of mine who in the summertime did this outdoor jog. I think it was on like Seymour Mountain where he signed up. It was with Lululemon. You pay, $100. You get to, they time you and everything. And then they also they gave him like a t-shirt. So that was pretty cool. And then obviously it gets you talking about that. He told me about it. So it's a pretty cool little way that they have to spread the word. So just another little point, I actually was an ambassador for Lululemon. So I owned a personal training business. And it was really easy process. You just joined up. At the time, this was probably like 15 years ago. I wasn't at the level they would just give me stuff. They would give me like a nice, I think I got like 20% off of gear. And basically all they did was they wanted me to tell them about what I thought about the gear. So, what did I like about it or what did I not like about it? And it seemed like they were legitimately interested in trying to improve the quality of their gear and obviously make it really, really usable for the customers and improve it as well. So I thought that was really, really cool. And, I obviously I worked in a personal training setting, so people would see what I was wearing and, that kind of leads off into their free advertising aspect.
Mm-hmm. And Chip really had this passion for innovation. I believe the term he used a lot in his book was technical apparel. So he is analyzing every single aspect of every single item of clothing and figuring out how can he make this, as comfortable as possible, as fashionable as he can make it. And there's a couple points related to what you're saying there. So at the top, you said that really what sets them apart is their brand. And when I think of Lululemon, I sort of think of the status symbol aspect of it or what it signals when you're wearing Lululemon. Chip was never big on like having a giant Lululemon logo, but when you see the clothing, you can kind of tell what it is someone's wearing. So it kind of reminds me of like a Starbucks or an Apple here in the US. People don't really care to pay more for these brand name products. They like what it signals. They like the quality. And they know they could get maybe something a little bit similar for a bit cheaper, but they're definitely willing to pay up for that brand of value and what it signals to others. And that obviously gives companies like Lulu a pretty strong pricing power. And I also liked what you said about the return policy. Just points to wanting to take good care of your customers. Many customers are more than happy to spend thousands of dollars a year at Lululemon. And the lifetime value of a customer like that is just extraordinarily high. And I just really like to see companies like Lulu that just, generally want to take really good care of their customers, fix products for free, essentially, and ensure it's going to last a long time and just deliver on their promise of quality. So what's also interesting about Lululemon's business is they're fully vertically integrated. So the company is involved in every step of the production process, and they almost exclusively sell their own products. So if you want to buy their clothes, you pretty much have to go to their store or purchase from their store online. It looks like I was searching around online, and it seems like you can buy some stuff on Amazon. So, it seems like you can buy some things outside of their sort of ecosystem, but they seem to be very mindful of where you can purchase their products. And because of this control they have over how their products are purchased, it also gives them a lot of control on how their brand is perceived and experienced by their customers. And in retailing, it's definitely a common practice to do a lot of discounting. And because they don't let other stores sell their clothing, then they have full control over how their product is sold. So, of course, something like a discount can boost sales in the short term, but it can dilute the brand value over the long term. So I think that's part of the story of why they also have significant pricing power. And I also like to put a lot of emphasis on how much staying power a company has, especially in retail. A product can come out that's super successful, is priced really high, creates a lot of profits, and that's going to attract a lot of attention from competitors. So when those competitors step in and try and offer a similar product, maybe for a bit lower price, it really puts that company to the test of whether there's a real enduring moat there. So since 2006, Lululemon has increased their revenues every single year, and they've had exceptionally high return on invested capital over that time period. So 2006 to today, that's 18 years where they've increased revenues, and they've been able to overcome the competition that's come in. Today, their return on invested capital is 40% and return on capital employed is 46%. So, Lululemon has definitely caught the attention of a lot of other retailers, and there's been a lot of similar products that have been released. And I don't think it's really stopped them from, continuing their strategy of continuing to grow, really enter adjacent markets and continue to expand their store base, which we'll be getting to as well. And I almost think of their brand, like I mentioned, along the lines of an Apple or a Starbucks. Like it's here to stay, and it's an enduring brand. And there's more to the company than just selling a high quality product. There's much more to the story.
Yeah, exactly. And just wanted to rewind back to a point you brought up there about the vertical market. So it's funny because if you look at a company like Nike, they've actually kind of stepped back. Like they've actually pulled their product off the shelves of some of the retailers, like I know with Foot Locker, simply because the margins on selling online are a little higher, and they feel like obviously they can control their product a little bit better that way. So it just kind of goes to show you that, it's not to say that Lululemon's business model is like perfect or anything like that, but it's just, it is a good business model when you can control more of your own product. And it's interesting just to see some of these other big names like Nike kind of moving in that exact same direction. The other thing you mentioned was that I liked how sales can go up and end up doing more harm than good to a company's brand, as excessive sales can signal that the brand isn't as valuable compared to a business which doesn't require discounting its apparel to attract customers. So, all these brands that discount all the time, obviously that's a signal to its customers that maybe its apparel just isn't as valuable. Whereas a business like Lululemon, they don't have to do that. They do have sales every now and then, but it's not very, it's like Apple, right? You go in and buy an Apple product, it's like never on sale. And if you find it on sale, it's usually like less than 10%, and you feel like you're really, really lucky. So yeah, Lululemon it's not a discounter. And I think that's been a really big part of the reason that they've been able to keep their apparel at this high price for a long period of time. People know that the quality is good, and they know what they're going to get when they buy it. So I just want to mention Hamilton Helmer one more time here. So part of looking at the barrier to entry of a brand is that, quote, a strong brand can only be created over a lengthy period of time of reinforcing actions, which he calls hysteresis, which itself serves as a key barrier, unquote. So Lululemon has done an exceptional job, I think, of developing its brand over multiple decades now. And I think this further cements their barrier against incumbents. So athleisure, it's very competitive space. There's tons and tons of brands that are trying to take market share, and there aren't that many barriers to entry. So if we look at the fact that I feel that Lululemon does have this somewhat barrier to entry, it shows that Lululemon is doing something right. So one way that we can look to see if Lululemon's doing something right versus competitors is just to look at their margins. So if we look at their gross margins, Lululemon's gross margins 58%, Nike 44%, Under Armour 45%, Adidas 48%. So this simply shows that they're able to price their apparel a little bit higher than some of the other titans of the industry. And in Lulu's case, that's only strengthened. So if we go back in time to 2016, gross margins back then were 48% versus the 58% today. So it's just getting better and better and stronger and stronger. And that's not all. So when we look at margins, we also want to know that money is dropping down to the bottom line, and they're getting more and more profit. So if we could just use net margins for that case. So once again, Lululemon shines very bright here. So net margins for Lululemon are 16%. For Nike, 10%, Under Armour, 6.6%, and Adidas, negative 0.4%. But I don't know too much about Adidas. I assume they're going through some short-term headwinds, but over the last decade, it's been around the mid-single digits. So, they have better net margins than all of these companies. So this means that when we run down an income statement, Lululemon is converting profits at just a much higher rate compared to some of these other, super strong, well-known athleisure brands. So you can make the argument that it's not the best comparison because these other brands aren't exclusively in athleisure. They all sell shoes, for instance, and other types of sporting equipment where Lululemon doesn't. Although Lululemon does sell shoes, but it's a very, very small percent of its revenue right now. But I still think it shows the strength of Lululemon's brand when you compare them to some of these other businesses. So like Clay has already alluded to, Lululemon has a vertically integrated business model, and they don't partner with other retailers to sell their products other than Amazon, which I actually didn't even know that Amazon sold their products. So this means that they have full control over a few things. 1, pricing. 2, the retail environment. 3, brand power. And 4, the customer experience. So they don't rely on letting others sell their gear, which, like I just kind of talked about with that Nike and Foot Locker example, it does compress your margins. So when you sell it all yourself, you're able to really, really protect your brand. And like all good brands, you want to reduce uncertainty, as I previously mentioned. You don't want people buying Lululemon pants and some people being really happy, and then other people having their stuff fall apart after a day. Because then you're reducing that uncertainty. People want certainty, and that's why they'll pay up for it. That's why, like Clay said, with Apple and Starbucks, people are willing to pay. They know what they're going to get. They know they're going to get a really good product, and it's very, very rare that they're going to be disappointed. So one way that Lulu does this is by having uniform stores. So Lululemon stores are all laid out very similarly. They have kind of a distinct vibe to them, and they express a higher end product. So if you step into a store, you'll feel it. You'll feel it yourself. It's just it's a really high quality experience. It's really clean. Everything is displayed in a really, really nice way, and you can tell that they put work into making it look the way that they make it look. And then, so, when you shop at Lululemon, I've been to, of course, a whole bunch in Vancouver. I went to the one in New York. I know the experience was the same. It looks the same. The customer service is the same. And only businesses that are selling its own product can really offer this advantage. If you look at Nike, for instance, if you were to go into a Foot Locker when they were holding their stuff versus, a Champs or a Nike store, chances are that your customer experience is going to be different. And that kind of changes the way that your brand is seen in customers' eyes. So one comment I had on margin improvement is that part of the reason for the above average margins versus competitors is that Lulu has been growing its e-commerce business at high rates, which has offered a lot of economic benefits over selling in retail locations. So we'll be covering this in a little more detail later on.
Yeah, and just to tap a little bit more into the innovation piece and the vertically integrated business model, having their own stores allowed them to easily test out new products and adjust to consumer tastes. So while these bigger brands that don't have as much control, they might be more hesitant or might even have more difficulty testing out different products or testing out different variations, whereas that wasn't an issue at all for Lululemon. And I listened to the audiobook. Chip Wilson wrote this book called The Story of Lululemon, and it sort of gave me get me up to speed on your level of how well you know Lululemon. And it was a good read to get a sense of what the company is all about and what its vision was from the beginning. And one thing that was interesting from the book was how Chip was really able to see these trends that were coming and capitalize them. So he could see, hey, we're in the early innings of this surfing trend or this skateboarding trend like he did with West Beach. And it was in 1998 when he started Lulu. He's like, hey, I think yoga is still in its early innings. And he kind of hit the ball out of the ballpark with that one, just like he did with his previous company. These types of biographies or these books that you read of these stories, they're great because you get to hear the story of how the business was born, sort of the DNA. You get a sense of, their culture and what was behind the thinking of the entrepreneur from the beginning and some of the growing pains they had to go through. And you really sort of gain an appreciation of what it takes to grow a multi-billion-dollar company. And just, it sounds sort of easy when you just see these brands out in the streets, but there's a lot of work and a lot of pain that goes into it from someone like Chip. And one thing that I also found interesting from the book is that you talked a bit about the brand ambassadors, and he really took to heart to get feedback from all these ambassadors and continually innovate the product. So it's this continuous iteration of, it's not Chip saying, hey, we got to do the product this way. It's getting feedback primarily from a lot of women because they're selling to women. So that's who he's getting feedback from. And that's who a lot of these ambassadors are. So he really embraced innovation as a part of one of their core values. And as you mentioned, they've really been a huge beneficiary to the trend towards e-commerce. So initially, we may not have seen a huge growth in e-commerce when they started in 1998, but today it's a core part of their business. So if you look back 5 years ago, and you look at the revenues for their store sales, and then you look at their e-commerce, in 2019, they did 2.1 billion in sales in their stores, and then they did 850 million in their e-commerce segment. And you fast forward to today, the stores did $4.4 billion in revenue, and then the e-commerce segment did 4.3 billion. So the e-commerce segment has nearly surpassed their store sales, despite the in-store sales continuing to grow at a fast clip. They're continuing to open new stores. There's just so much tailwinds right now behind the business. And 15 years ago, the e-commerce segment had barely existed. And then, Chip, right after they went public, they actually released their e-commerce. And I think that's another example of Chip sort of seeing where things were heading. He definitely wanted to control how the brand was viewed in the eyes of consumers. And he had to be really thoughtful in, releasing that e-commerce segment, because it's a much different ballgame than having your own stores. And they knocked the ball out of the ballpark on that one. And then I also wanted to touch on revenue by geography. So Lulu initially started in Vancouver, started to expand in the US, and did so very successfully. When you look at over the past year, over 65% of revenue came from the US, and then ever increasing part is coming from China. So China is definitely a key part of their growth strategy. They didn't receive any revenue from China 3 years ago, and since then they've just seen substantial growth. So today, nearly 12% of revenue comes from China, and again, that segment's just growing very rapidly. It grew by over 60% over the past year. Revenue in the US grew by around 12%. So really a lot of that growth is coming from China, but it's a smaller segment. You're still seeing pretty good growth from the US. And then the e-commerce is also providing them a lot of growth as well.
Yeah, so the growth along geographies has been great, as Clay pointed out, especially when you look at China and outside of North America. But they have a lot of growth drivers going ahead. So they currently have a growth initiative that they call the Power of Three. So this was initiated in 2022. The main goal is to double the business's net revenue from 6.25 billion in 2021 to about 12.5 billion by 2026. So the three growth initiatives are: 1, product innovation; 2, guest experience; and 3, market expansion. So their trailing 12 months net revenues today are about 9.6 billion. So they look pretty much right on schedule, compounding revenues around that kind of 15% per annum number. But let's dig into some of these growth levers in a little more detail. So product innovation is the DNA of Lululemon, as Clay was just kind of talking about with Chip Wilson. Like, that was a really, really big part of the company, and they've continued to do that. So, it's not really surprising that they're planning to keep their gear fresh and continue expanding to adjacent markets. So they started in yoga, but obviously, Clay listed off a bunch, but I'm just going to relist a couple here. Other verticals are in, which is running, CrossFit, hiking, swimwear, golf, tennis, gym gear. They're also dipping their toes into footwear now, as they offer a men's and women's shoes as well. But, though that's in its very infancy. So it's worth noting that, like Clay said, their sales are 2/3 to females and 1/3 to male. But this has grown from 0% male share to where it is today, which is very impressive, because it's been growing at a very fast pace. So when it comes to the guest experience, they're at the forefront of omnichannel sales, which is simply that they have different sales channels that customers can buy their products from. So while their retail segment has been growing revenues at about 15% per annum for the last 5 years, Clay just mentioned it was 12% in the last year. So it's decent growth. Nothing super spectacular. But when you look at their direct to consumer growth, which is like Clay also pointed out, which is essentially just their e-commerce, this has grown at 40%. So it's growing like an absolute weed. And part of the strength of the direct to consumer portion of the business is that the community angle that I already outlined. So this serves as an excellent augment to their retail sales channel and allows for the growth of their brand utilizing e-commerce. So I just wanted to share a really interesting bit of info I listened to when I was listening to a really good interview with Chip Wilson that he had with Tim Ferriss. And this is when he was talking about how he crafted his stores to best serve customers. So, quote, Basically, I was setting it up because I understood clearly from listening to women that they were time constrained. And if they could get in and out of a store in under 10 minutes with exactly what they wanted, then I was actually saving them $100 or $200 because I always came from that our customers were making $100 an hour who were coming into the store. So then we set up the right amounts of change rooms so they never had to wait for a change room. We did hang tags all on the same side. We had the price that was big, the size that was so big, so that it was easy to read. You didn't have to search for anything. The store was set up functionally, so you'd get what you want in the change room. There were three-way mirrors, so a girl didn't have to come out, have someone to ask how they looked in something. They could actually check their own sides out if they wanted to inside of the change room. Our cash registers had the fastest checkout. By the time you scanned it and got the price out, you're out the door. So I think women really appreciated that, unquote. So these are just a good example of some of the very small details that Lululemon tried to pay attention to that really stood out to me. And I think this has helped really keep their brand strong because their customer service obviously is very customer centered and they want to just serve them at a very, very high level. So when we look at market expansion, they're obviously targeting China and the rest of the world to generate a lot of the future growth. As Clay pointed out, North America is slowing down. So I think that other geographies are going to pick up. It's also worth noting that on menswear, they've done a very good job of growing this segment. So if we look back at their initiatives, they had another initiative, I believe it was in 2020 or 2021, where they were going to double men's revenue by 2023. And they did that like very easily. So another part of the expansion plan was to quadruple revenue outside of North America. So in 2021, this figure was 624 million. As of today, it's 1.9 million. So they've nearly achieved that goal. They've tripled, and they still have 2 years remaining on their initiative. So I think that they've executed at a very high level.
Hey guys, it's Clay Finck here, host of We Study Billionaires. Today, I wanted to tell you about our show sponsor, Vacasa. The dream of owning a vacation home can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. With Vacasa, they make that dream into a reality. As a full-service vacation home management company with vacation homes in key destinations across the US, they know how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a data-driven booking platform, and around-the-clock support, homeowners earn on average 20% more revenue from their vacation homes. Vacasa makes vacation home ownership easy. If you're looking to make more from your vacation homes by doing less, partner with Vacasa at vacasa.com. That's vacasa.com. So next I wanted to talk a little bit about what I found on the competitive landscape for Lululemon. There's a host of competitors to mention here. So the global activewear market is massive. It's north of $350 billion, and Lululemon only captures 2% of this market, despite them being a very big company today. But Lululemon focuses much more on the yoga niche. So the yoga niche is a much smaller market. It's estimated to be $25 to $30 billion, and they capture around 25 to 30% based on the data I was seeing on this. The activewear market is very stable, very mature. It's growing at around 3 to 4% per year, so around the inflation rate. And the yoga market's growing a bit faster. It's growing at over 8% a year, so that's a nice little tailwind for Lululemon being focused on that niche. And then when you look at the major competitors, we've talked about the legacy players, Nike, Adidas, Under Armour. And then you have these premium brands sort of popping up that I feel like I see a new one every year that I've never seen before that are, somewhat similar to Lulu, but maybe they're targeting a different type of customer, different type of products. So some of the players that I found were Sweaty Betty, Alo Yoga, Fabletics, Beyond Yoga, Public Rec, and then a member of our Mastermind community also mentioned to me Viore, which he said his family swears by. It's tough to say what some of these brands are really targeting, but many people I've talked to that are familiar with the industry have stated that this industry is very competitive, and everyone knows that retail is not an easy game to play. And I just think a lot of these businesses have different strategies, though. So some might sell yoga pants like Lulu does, but they might be targeting, a different type of consumer. Maybe it's more casual. Maybe it's a different segment within the women's market or whatnot. Or a lot of companies are really just trying to capitalize on this trend of athleisure. And as I've hosted the show for some time now, I've sort of realized that people like to oversimplify some of these things when it comes to particular markets. I think in the case of Lulu, they might say that, this space is just way too competitive. And, it is true. It is really competitive and there's a lot of players, but you can't overlook just how big this market is. And there's plenty of different segments within the market and plenty of different types of customers. So Lulu doesn't have to take 90% of the yoga market to be successful. And after doing some research, it seems that Lulu definitely is still a very high quality product relative to many of these other brands. And they still have the strong brand recognition. And I think that's one of the bigger risks we should maybe touch on. They need to keep that brand strength intact, and that can't be jeopardized going forward. And it's a really key part of their continued strategy of growth in China and growth of their e-commerce segment. And there's just so many companies out there selling apparel, and they're going to need that type of recognition, especially to earn the returns on capital that they have. And really, at the end of the day, any company can make a high quality legging or a high quality shoe or whatnot. It's really going the extra mile and creating that positive emotional response that you highlighted towards the beginning. And clothes to a certain extent are a commodity, and Chip realized this. He saw the skateboard and the surf brand, is much. It was just, he just saw how difficult it was to have a sustained high quality brand, and so many of these types of segments just become commoditized, and that, I think that served as a strong lesson for him in building Lulu. And he knows that he needs to figure out a way to, well, I guess it's not him. They have a new CEO today, but they know they need to have reasons to justify the higher prices they charge. And then, definitely offer a good value proposition, a differentiated product, the community aspect. So maybe you can mention a couple of the risks you see with Lululemon, and some of the things investors should watch out for with them.
Yeah, absolutely. So, a lot of kind of these retail businesses have similar risks, and Clay pointed out a lot of them, but I'll just add a couple of my own. So one of the risks is like product assortment. So obviously, with a lot of these retailers that are, creating products for specific seasons, you got to make sure that you have, the right gear for the right season. And then the other thing that I find really interesting, especially with a company like Lululemon, is, they're really well known for their leggings, right? But they've diversified away from it. But at the same time, they've still kind of stuck with, their core products. They know their leggings do really well. So they've done a good job of kind of innovating and creating like adjacent products around, the leggings, but they've also been well diversified, making jackets and, backpacks and other, socks, boxer briefs, things like that. So, I think they've done a really good job on that, but obviously product assortment, it matters a lot. So you can look at inventory, and I'll be talking about that a little bit shortly, so I won't get too much into that. You got to maintain a level of excitement for your products. That just kind of comes down to, making sure that your product is functional. And obviously, Clay's pointed out multiple times that Chip Wilson was really, really into emphasizing that their gear was functional and works really well, and tested the test of time. Another thing that's really important for brands is obviously staying on top of your customers' minds. If your customers' minds are transferring over to another product, well, chances are that it's going to be hard to get them back to focusing on yours. So that just kind of comes through advertising, and like I already said, they don't have to advertise on much, but you just see so many people wearing it, and it's pretty easy to identify that people are wearing it. So it's kind of the self-reinforcing thing, but obviously it is important to keep atop of customers' minds. I know one of their biggest suppliers, I believe their one garment uses this, they call it Luon, I believe, Luon. And I think they get almost all of that from Taiwan. So, if you're looking at specific risks, obviously there's always geopolitical tensions going on between China and Taiwan. So, if something were to happen, that could be a pretty big negative for their supply chain. And then just obviously be back on that is just the China risk. Obviously China has been a huge growth lever for them. So if something were to happen with China and our relations with them went south, well, there's a chance that everything in China could go to zero. So I think those are kind of the biggest risks to pay attention to. Are there any others that you can think of, Clay?
No, I think that about hits it. How about we turn to the management?
Absolutely. So when we look at management, one thing that I like to look at, this is just kind of, zooming out just in general, is I like to look at management that is forward thinking and, isn't just trying to look to Wall Street and tell them that next quarter is going to be good. I actually prefer someone who just is looking, 5 years into the future. So I really like the fact that Lululemon has this power of 3 where they are looking 5 years into the future. So we already covered the growth initiative, the power of 3, but I really like the fact that they have these kind of long-term views, which allows them to kind of accept the fact that, yeah, okay, there might be quarters like the last one that aren't so good, but we're focusing on where we're going to be in 5 years. And I really like that. So I think that really shows you just that management is focused on looking out. And then the thing that's cool is that, some of these management teams or businesses that just aren't as good, they'll get these initiatives and then they'll fail at it. And then so if you look back in time, they have these initiatives, you look now, they don't talk about it at all. And that's a really, really good signal that that's probably a business you don't want to be in. And I was just really impressed because I actually think that Lululemon had a 5-year program, and I can't remember the exact date, but they smashed it. And basically they had to come up with this new 5-year program. I don't know how many years in advance, but basically like the 5-year program, they smashed it and they just did another one. And that's where they are now. So that's execution, I think, at a really high level. So Lululemon is laser focused on growth right now. New store openings are growing at a 5-year compound annual growth rate of about 8.7%. They've gone from 491 to 711 stores. And these stores obviously cost money to open. So trailing 12-month capital expenditure is 6.8%. And if you contrast that with 5 years ago, still 6.8%. So we could probably continue to expect them to deploy capital into growth and maintenance at probably that 6.8% range. So if we look at fiscal 2023, depreciation and amortization was about $291 million, and they spent about $638 million on CapEx. So, 45% of CapEx is spent on growth and the rest on maintenance CapEx. So one thing that's cool about Lululemon, they have zero debt. They have a $400 million credit facility from 2021 that hasn't been drawn on yet. So they really don't need too much debt. Just looking at their balance sheet, they have a very strong balance sheet. So they have $1 billion in cash, which isn't that much, but like I said, they don't have any current or non-current debt liabilities. So they're in a very, very strong position to continue growing without the need for debt or to issue equity and obviously dilute shareholders. So super big strength of the business. I also like how they're keeping their cash position pretty low. It's been growing a little bit, but they're not like Berkshire that has whatever, I don't know how what it's at now, $158 billion that they can't put to work. Obviously Lululemon is a way smaller company, but it's nice to see that they can put their money to work, and they're doing a really, really good job of that. I want to just touch on inventory levels as well before we get back into management, but I think they're doing a really good job of managing their inventory. Inventory's grown at about 23% over the last decade versus about 21% in revenue. So I think they're doing a really good job of making sure that they're turning over their inventory and not being stuck with inventory that they can't sell, which is a problem for many retailers that, aren't doing quite so good of a job. So yeah, and then just kind of touching on dilution, obviously I mentioned that due to the fact that they probably don't need to issue equity, they're probably not going to dilute shareholders. The only other way, obviously, they can dilute shareholders with share-based compensation. And it's pretty nice to see that their share-based compensation this year was 0.1% of revenue. So super, super low. And management is also, on top of that, they've reduced share count from about 142 million in 2016 to about 126 million today. So it's nice to see that. But obviously, while it's nice to see the share count going down, the buybacks were made when Lululemon's price to earnings was about 30 times or higher. So, if we look at the yield on that, we're getting at most about 3.3% earnings yield. And, obviously we've been in this ridiculously low interest world. So if you're comparing it to interest rates, well, then yes, buying back your shares, I guess, makes a little bit of sense. But when you add in the facts, like Clay said, with this astronomically high ROIC, and just going back in time, the lowest their ROIC has been in the last decade was 27%. So, I mean, I don't know, you can make your own judgment call on whether you'd like get the 3.3% from buybacks or just reinvesting in the company. So I want to move on now to manager compensation. So they have an interesting plan where executives must retain a percent of their annual salary as shares in Lululemon, which I like. The CEO must have 5 times their salary in shares, and other executives must have 3 times. So they are allowed to include options, performance stock units, and reserve stock units in this number. But I like that. At least it kind of keeps the management somewhat aligned with shareholders. Base salary for executives is reasonable. So the CEO, Calvin McDonald, had a base salary of $1.3 million. Other named executives are between 700 and 900K. This seemed to be somewhat aligned with competitors like Nike. So the options plan is very lucrative, though, for execs in Lululemon. So Calvin McDonald has received total compensation of $10.6 million in 2020, $11.3 million in 2021, and $15.6 million in 2022. Just to compare, Nike's CEO received $10.2 million in total compensation in 2023, according to salary.com. So as for the incentive program, the CEO is paid on total shareholder returns, net income, and operating income growth. So I'm not crazy about total shareholder return incentives, simply because it can make it so that a CEO will take short-term risks in order to increase their share price at a fast rate in the short term. But unfortunately for the long term, that usually just ends up not working out very well. So the profit incentives also can be bad for certain businesses, but in my opinion, it actually does make really good sense for Lululemon. So the reason that earnings incentives can be bad is kind of similar to shareholder return. You can basically just spend a bunch of money, buy a company that has a bunch of earnings, and then just bolt that onto your business, and bam, there you go. You just increased earnings without really doing much, and you can actually do that without creating any value and actually destroying value. But the thing that I think that it makes sense for Lululemon is that they're not an acquisitive company. As Clay pointed out earlier, it's all their growth is organic growth. They're not having to buy other things. They have gone in and bought a few things that I will mention, but they've been very, very small. So, overall, the incentive program I think it works well for the company. If you look at Lululemon's operating margins over time, they've done really, really well, and I think that's probably part of the reason that the CEO is incentivized for that. So if you look at operating margins from 2015, they were about 21%, trailing 12 months, 23%. And then net margins in 2015 were 13%, and today they're 16%. So you're seeing a really nice gain in there, and that's probably partly driven by the incentive program of management. So as of their last proxy statement of April 2023, insider ownership isn't great. So this is one of the bigger, I guess you can call it a yellow flag, but there's about 693,000 shares that are owned by executives and directors as a group, and that includes options. So this only represents about 0.5% of diluted shares outstanding. As Clay pointed out, the founder, Chip Wilson, still owns about 8.5% of the shares outstanding. But it is worth noting, he's not part of the business anymore. He's not on the board or anything like that or making decisions. So I think it is worth it, though, to look at how much as a percent of shares that, the CEO has as a percentage of his net worth. So I used something called Wallmine, which is a site, and it said that the CEO, Calvin McDonald's net worth was around 50 million. This was in the end of 2023. And they said that he also owned about $38 million of Lulu stock at that time. So that means about 76% of his net worth is in Lululemon stock, which I think is pretty good alignment. And now if we look back at Calvin McDonald's track record as the CEO of Lululemon, it's been really good. So he took over in August of 2018. And at this time, the market cap of Lululemon was about $17.3 billion. As of April 3rd, 2024, the market cap is $47.64 billion. So, if we look at that as a compound annual rate, that's 18.3%. Obviously, that's very, very good. If we look at just how much he's grown earnings per share, he's taken them from $1.9 per share in 2018 to $12.2 per share in trailing 12 months. So that's a 36.3% CAGR. So I think he's doing a very, very good job on that front. And then another metric that I like to use that I stole from Buffett here is rule of one, which is basically each dollar retained by the company should produce at least $1 of value for shareholders. So if we just look at the time that Calvin's been in charge, we can see that he's retained about $2.5 billion and put that back into the business to work. And the market cap has increased from $17.3 billion to $47.64 billion, which is a difference of $30.34 billion. So for each dollar that has been retained by Lululemon, they've created $12.13 of value for shareholders. So that's very, very good. Just a little bit of background on Calvin. He was the president of Sephora Americas between 2013 and 2018. Sephora is owned by LVMH, which is good, but it also means that it's a little bit harder to get an accurate picture of his performance at Sephora because they're just folded in as a consolidated number. So, he was there for 5 years. I assume he did a pretty good job because he didn't get fired or anything. He actually left the business to take this job with Lululemon. Then another thing, obviously, with CEOs, I just like to make sure I delineate between if they're types of CEOs that really love attention or if they just avoid attention. So Calvin's appeared on CNBC and a few podcast episodes. It's not a lot, but it's just something to observe. So he's not a recluse by any means, but I don't think he's wasting too much time on doing public relations. And then just the final thing I want to mention, I did mention about mergers and acquisitions, is they actually have had one acquisition. So this was the Mirror. So you might have seen ads or seen this talked about kind of closer and more in the COVID times when everyone was staying home, but it was basically just a mirror that you hung up on your wall, and you could obviously look in yourself, but it also kind of acted as like a giant iPad where you could just do exercise in front of it and it would tell you what to do. So at the time, Peloton obviously was doing really well because of this huge movement towards home fitness. And so Lululemon wanted to get a piece of that. So that's why they bought Mirror for $500 million. As of October 2023, they just wrote that investment down at a value of only $72.1 million. So, it's basically shut down and it didn't work out very well. They're not selling the hardware anymore. In its place, they made a 5-year deal with Peloton. It's pretty tough to evaluate this just because I think it's new. And as far as I could see, they weren't really talking too much about how much money that was giving off. But the point being that Mirror was not a very good investment for them, but luckily, it was a little bit smaller and, it didn't move the needle much for them.
Thank you for that wonderful breakdown on the risks and the management. One of the reasons that we started this series, Kyle, is that we very much align on how we want to invest in stocks. We believe that winners tend to keep on winning. And I just had an episode come out. It's going to be after this is recorded, with Joseph Shaposhnik, and he shared some wonderful reasons why we should focus on business quality. If you enjoyed this episode and haven't tuned into that one, I'd highly recommend it. He pointed to a statistic on, these quality businesses tend to remain high quality and low quality tends to remain low quality. And I'm also reminded when you mentioned the Mirror acquisition, it's very unfortunate to see, but it reminds me of Pulak Prasad's point that these quality businesses, they're able to take some of these risks and maybe go out and make an acquisition. And it's just the core business, it doesn't affect it at all. The business is churning along just as it always has. And, if you would have bought the stock, when they made that mirror acquisition, you would have turned out just fine as an investor. So yeah, it is unfortunate that they made that mistake, but hopefully they learned from it. So I wanted to turn here to valuation and capital allocation. I'll try and keep it as simple as possible. It's hard not to mention too many numbers when talking valuation, but given my love for numbers, sometimes I just can't help myself. So at the time of recording, the stock's actually traded down from their recent quarterly results, and that's kind of how it got brought up on my radar. And some of the people I follow have shared write-ups on Lulu, so it's pretty funny how a lot of people in our circles have kind of been attracted to this quality name. And yeah, sometimes, if a company has return on invested capital of 40% and it's down from over 500 to 360, that catches a lot of people's attention. At the end of 2023, yeah, like I mentioned, the stock was over 500. It's down 30% from its high. And in the recent quarter, revenue increased by 16%. The bottom line net income also increased by 16%. And their store count today sits at 711. Recent quarter, they opened 25 new stores, so they're continuing to expand their footprint there. And with this, when we look at the multiples for Lulu, it seems to be attractive relative to where it's been historically. The EV to EBIT, for example, now sits around 20. So you're looking at around a 5% earnings yield with a company that's growing at a pretty good pace. Looking historically at this multiple, this figure is pretty distorted in 2020 due to the shutdowns and a lot of their stores being closed for a period. Just prior to COVID, this multiple, just for reference, was 38. And ever since 2022, we've really seen it sort of normalize, and now it's hitting new lows. When we look at Nike's EV to EBIT, it's 23. And their return on invested capital isn't near as high as Lululemon's. And I think we could also argue that Lululemon is a higher quality business, but that's discussion for another day. And I don't think the stock is drastically overvalued, looking at, the company's return prospects, their growth prospects, and how they're reinvesting. So I like to look at what is the company doing with their current earnings? And then how is that going to affect their future growth in revenue and earnings? And to start with that, I like to look at Buffett's owner's earnings figure. So this is calculated as net income plus depreciation and amortization, other non-cash charges, minus maintenance CapEx. And this is something, the maintenance CapEx is something we have to estimate ourselves as investors. So that the company has their capital expenditures, and we have to estimate some portion of that's for growth. Some portion of that is just to maintain their existing business. So I estimated the owner's earnings to be around 1.5 billion, and then their market cap today is around 45 billion. So that gives us a nice round multiple of 30 to put things in perspective. And then with that cash flow, close to half of it is being allocated towards capital expenditures, maintenance and growth. And a lot of the cash flow is also going towards share repurchases. I think some more conservative investors might like that capital being returned to them, but some could also argue that, it's when the stock starts trading up, it's probably not great for them to, be doing repurchases because, maybe they could distribute the dividend. You can't, it's hard to expect a company like this to reinvest 100% of their cash flows. It's just really difficult to do. And I also like to see just like stable conservative growth over time too. So yeah, it's some investors probably like the buyback. Others might not like it as much. And then the remainder, there's a little bit of cash that likely just sticks on the balance sheet, and it gives them some optionality, gives them the ability to potentially invest in new product lines and continue innovating. So I like that they're fairly balanced in terms of their capital allocation. And I like that they, like you mentioned, have a really strong balance sheet. They currently don't pay a dividend. Maybe we'll see a dividend at some point in the future if the stock runs back up and gets to elevated levels. So assuming that they're able to keep the US segment growing at double-digit rates, say 12 to 15%, their expansion into China continues to go as planned, and then the e-commerce segment continues to grow at a healthy clip, I'd personally expect and expect to return something like 12 to 15%. Generally, this company is under-promised and over-delivered. So we could see rates higher than that. But in the past couple of years, their revenue growth rates have come down a bit. They got a huge boost post-COVID, and now you're seeing things start to normalize. And this is a stock, like I said, a winner that tends to keep on winning. I mean, year after year, it's just been a strong outperformer. And given that it's at what I would argue a reasonable valuation today, I have no reason to believe that that strong outperformance won't continue. And this is a stock that's had its fair share of moderate pullbacks since 2006. And as with most stocks in the market, it's one of these I think you could have taken advantage of the mood swings in the market and have pretty good returns if you're a more opportunistic investor. And on the flip side, if we look at the potential downside, we see the slowing revenue growth. It was 15% overall, or 15 or 16% in the recent quarter. A year ago, revenue growth rate was 30%. So they got a big boost from COVID, and they're seeing slowing growth in the US, and management guides for revenue growth of around 11 to 12% in fiscal year 2024. But they still expect revenue to grow at 15% over the longer terms. Retail's a bit cyclical, and they expect 15% growth over the next 5+ years. And again, they tend to over deliver, and the share price drop might be a good opportunity to investors that want to get into more of like a blue chip, well-known name that a lot of investors already know about. Can sleep well at night owning a company like this, I think. And then looking back historically, the growth rates have been quite attractive. So for example, we've mentioned a lot of numbers on this show, but over the past 5 years, free cash flows have compounded at 22% per year. And that's while they're doing, a lot of buybacks. They're not having to reinvest 100% of their capital to achieve that exceptional growth. And that growth in free cash flow has led to the stock being a strong compounder.
Yeah, Clay, I agree. I think your valuations, your valuation assumptions, all sound very reasonable and conservative with kind of an embedded margin of safety into those numbers. With that assumption that you are making 12 to 15% range with some upside optionality, just as you said, they do keep out delivering. So I feel that's a good kind of base to build off of. If we look at part of the life cycle that Lululemon is in, they're still in growth stage, but they also have embedded competitive advantages. So they're still reinvesting capital back into the business at high returns on invested capital, which is great. They still have a lot of reinvestments to go before they become a mature business and start to kind of be forced to redistribute earnings back to shareholders. I think if we look at the business over the next few years or decades, if they are redistributing back to shareholders, that probably means that returns are probably just going to go down a little bit, because it just means that they're not able to sustain their high returns on invested capital if they're going to pump more and more money into the business, and that's why they're redistributing it. So right now, I really like the balance of the business being mature but still growing and reinvesting, and not having to redistribute everything to their shareholders. So once I own a business, let's say I did own Lululemon, I don't. I like to keep track of key performance indicators, KPIs. So for Lululemon, if I was to own it, it would come down to me tracking the following. So number one would be returns on invested capital. We've obviously talked a lot about that and thrown out a lot of numbers, but essentially I would just, obviously if it could keep growing, that would be great. But given how high it is, if they can just maintain it, or even if it dropped a little bit and they just maintain that number, I would be very happy. But I think it's very important that if you are seeing a steady downtrend in the returns on invested capital, that could be a very, very good signal that their moat, which is their brand strength, starting to erode, and that would be something that you need to pay very close attention to. Kind of on the same front, looking quantitatively, if we look at things like net margins and free cash flow margins, we want to see, obviously in a perfect world, it would be awesome if they could continue increasing those. They can't keep increasing it, into infinity. Otherwise become 100%, and that's not going to happen. But, just going from, I think, I mentioned earlier that net margin have gone from 13% to about 16% from 2015 to today. That it's only 3% difference, but that adds a lot of value to the business. So, I'm not sure what they can take those margins to, but I would definitely pay attention for the same reason. If you're seeing margins come down, that means that they're probably having to spend more money in other areas of the business. And that also is a pretty good KPI to watch to make sure that their competitive advantages are being maintained. I would definitely pay a lot of attention to their growth, especially outside of North America. We know North America is, now it's kind of getting into that more mature base. It's still growing at a really nice rate, but you're not going to see it growing at the same rates that it has in history, and you're not going to see it grow at the same rates that the China and rest of the world is going to be growing at. So I would definitely be paying attention to how those things are growing, specifically because if you are buying this to get growth, then that's kind of going to be one of the bigger growth drivers. I would also be paying attention to men's product revenue. We know that, they've grown that from 0 to a third of their revenue today. So, will it ever be 50%? I don't know. Probably not. I just think that with the DNA of the company kind of embedded in women's wear, it probably always skew to that. But, could it go to 40% or 45%? I don't know, maybe. And obviously that would provide a lot of value for shareholders. Store count. So this is kind of just a general number for a retail company. Obviously, more stores you have, if they're all selling stuff, a similar amount of stuff, you want more stores because you're going to be making more money. Another thing also that's really interesting just for these kind of omni-channel businesses is that sometimes, someone might go into a Lululemon, not feel like buying anything, but just go there to try stuff on. That gets the brand name into the top of their mind. Maybe a couple days later, they think about it. They say, oh, I like that, and that. Go online, buy it online. There you go. You got your direct to consumer e-commerce up, which obviously matters because the more stores you have, it just means that you get more foot traffic and more people talking about your product. And then lastly, I kind of just talked about the DTC or the e-commerce segment. It's growing insanely fast, and that's going to be a huge growth driver. So you definitely would want to see that business is continuing to grow at high rates.
Thank you for mentioning the KPIs there, Kyle. I can't remember where I've read it, but I believe I've read that Nike's business in China is 10x the size of Lululemon. So presumably there's a long runway in China, especially. And so that wraps our discussion on Lululemon. Before we close out the episode, I also wanted to talk a little bit about what's happening in our TIP Mastermind community. So at the time of recording here on April 9th, we have 115 members, and we're approaching our hard cap of 150 members before we close the group. I just had a call yesterday with a new member, and I just continue to be surprised by the quality of members that we have joining. So primarily we're seeing many entrepreneurs, high net worth individuals, and portfolio managers joining the group as of late. And we also require members to apply to join just to ensure that the overall group quality remains high. And we continually really want to raise the bar for the group overall. And for those who aren't familiar with the community, this is a place where we talk stocks, we share ideas, and it's a great just opportunity to network with other like-minded investors, especially if you're interested in the types of discussions we had today, or talking about quality companies, or maybe even a value type opportunity. And really this idea came about because we were putting together our live events in Omaha last year. And we just figured, instead of just, getting like-minded people together one weekend a year, why don't we just create a community and do this online 365 days of the year? And I had mentioned that call I had yesterday with a new member. This is with a lady who's been in the investment industry for over 20 years. And she does like some intense on the ground research on companies, global microcap investor. She's telling me she goes to the Philippines, India, all over Europe, and wherever she can find the best value. And it's just amazing to have these types of people joining. And she mentioned to me in 2021, she was ranked the 8th female fund manager in the country by CityWire. And then the other day, I also met just another really, really interesting member from Australia. And he was most certainly an entrepreneur at heart. He was working on using AI to help investors like you and I in our research and discovery process. And, using AI, it sounds almost a bit gimmicky, but he's actually trying to build something that's much more than just a chat bot that sends you cool responses that are very generic. So along with developing as an investor, being a part of this community, I also really appreciate the opportunity to network with just extremely interesting and talented and just very driven people. Just, you meet these people and when you think about a growth mindset, like so many of these people just really embody that, I think. And it's also just a great place to potentially get new stock ideas from members. We have weekly live Zoom calls and try and create these organic discussions and ways to interact with people in the group and chat about investing. So just to give the audience a sense of some of the things we do, for example, tomorrow, April 10th, you have a call on your quarterly portfolio update. In a few days, we're doing these breakout sessions to quickly meet new members. And then next week, Joseph Shaposhnik is also joining us for a Q&A session. And then in May 2024, we also have a couple of members of our community presenting individual companies. So one is a research analyst from a big value firm out of New York City. He's presenting MasterCard on May 8th. And then another member in the group that manages a fund, he's going to be presenting Mercado Libre on May 15th. And I should also mention that many of our members, understandably, live very busy lives. So we record every call that we do and, have a whole library of 60 videos that you can go back and watch that we've put together over the last year. And it's interesting, the portfolio updates you do. We've been surprised by the level of interest in those. And when I look at members, they really enjoy joining the calls and asking you questions and picking your brain on how you think about things. And each quarter, you essentially just share your portfolio, share the additions and the companies you may have sold during the quarter and your thought process on all of that. And you're making money. You're bringing in income. So presumably you continually have cash that you're looking to put to work. So I was curious if you could speak to why you think others are so interested in this and how it maybe helps you in managing your portfolio.
Yeah, the portfolio updates have done really well, Clay. It's funny. So I've done a couple of them now. Stig did one as well, a private one, not on TIP, but and that was very well attended as well. And I think the main reason is just simply that community members really enjoy talking about stocks and strategy. And when you kind of break it down to, my individual portfolio, you really get into the details of what I'm doing, why I'm doing it. And I think people just like learning from others and seeing if they can find some insights that maybe they can add or maybe they can improve upon. A lot of people probably disagree with, maybe some things I do. And so maybe they're seeing mistakes that I'm making that they can hopefully try to avoid themselves. But I think that it just provides value because it's something fun to talk about. People like talking about their portfolios and like talk about the stocks they own, like getting updated on those stocks. And so I try to do all that when I'm doing my updates. And then I get a ton out of doing these portfolio updates simply because, before I joined TIP, I would just have my own companies and I'd be in my own little sphere. Obviously I tried to look at the downside, but it's harder. And when I have like 115 other people looking at my decisions, I'm able to get all sorts of really cool perspectives that I couldn't get myself. And it just really helps me learn more. I mean, so like I obviously, whenever you make an investment, you are making assumptions, right? And so one thing that's been really interesting for me is that some of the community members will challenge my assumptions, and not necessarily, to say I'm wrong or whatever, but just to get me thinking. And I really, really appreciate it. So for instance, on my upcoming update, there's a member I know who's going to come, and he's a shareholder of both Dino Polska and Geronimo Martins, which is a parent company of Biedronka, which is a big competitor of Dino Polska. So he has some really, really good insights on Biedronka. And also he lives in Europe, whereas I live in Canada. So, he's a little bit closer. And so he's going to share a bunch of these insights with me, and it's really helpful because then I get to learn more about my competitors, and I love learning more about competitors because it helps me understand Dino Polska better. And obviously, if there's some reason for me to be concerned, I like to know what that is. So that really helps. And then on top of that, I think a lot of the members appreciate how transparent we are. So I really try to rub my nose on my mistakes, just like Charlie Munger would say. I try not to hide anything. If I have, everything that I sell, I talk about on the portfolio update, talk about why I sold it. People can probably share in the pain of losing money if I'm selling one that lost money, but I don't try to hide it. It's part of investing. No one bats 100. And, as Buffett has pointed out, he's right 3 or 4% of the time, and look where he is now. He's been wrong a lot. So, I really enjoy talking about my mistakes as well, because it really ingrains them into my mind and helped me try to not make them again in the future. And I hope that the community members that come on and talk to me also learn from my mistakes so that they're not making the same mistake that I was guilty of making.
What I also really like about the community is we have sort of this dynamic where we have all these different people with different interests, different skill sets, different schedules even. And like I look at you, Stig, and I, for example, who are all very involved in the community. So taking me, for example, I hop on a call with every new member that joins the community, and you also hop on calls with many members as well. And when I do these calls, I often brainstorm what types of things they would find value in, and maybe what are some ways they can contribute and add value to the group as well. Because if you have a lot of people that just contribute one write-up or one presentation a year, and you have a lot of people doing that, that's a lot of people just helping each other and sharing with others, and it really adds up substantially over time. So I thought of one of the portfolio managers in the group. I thought he had a really interesting background. I personally wanted to learn more from him, how he invests. So I set up a call with him in the community in early June where we can talk about his background, how he got to where he is today. And then we'll have a Q&A session at the end for members to ask questions. And then when I look at you, you just love to dive into individual companies. You were just talking about one of your company's competitors and managing your portfolio. So you can do things like, give a presentation on fundamental analysis or do a call about your portfolio. So it's really cool to me, how everyone can sort of has something to bring to the table, and everyone really is just benefiting that. And we're all on this journey of continuously learning, sharing, and improving. It's just really, really cool to be a part of.
Yeah, absolutely. I think that, the three of us bring all sorts of our own little specialties to the group, and it really helps create value for the community and allows us to give some pretty cool high level attention to our members. So I had a great chat with an Australian entrepreneur in the group who is in the building industry. And he was interested in a company that I presented and doing a 1-page write-up, which was Atlas Engineered Products. And so we were talking about some stuff, and he had some really interesting questions that I felt I didn't have a good enough grasp of, and I wanted to learn more. So I reached out to the CEO of Atlas, who I've met. And we had a great conversation, and I asked him a bunch of questions that my member wanted to know more about. And then I'm just going to be chatting with him in a couple of days and telling him more about what we talked about and answering some of his questions. So it's just really cool because, you just find all sorts of different perspectives and ways of looking at things. And, because our community just keeps growing bigger and bigger, we're getting more and more people with these really diverse backgrounds. So, if I'm researching a business, it's very likely that someone in the group has, a lot of experience in that industry. So like another example, I was just looking into Mater Group. I wrote a really long research for the community that was well received. And one of their members had reached out to me after reading it and told me that he had a lot of experience in the O&G industry, specifically in North America, where Mater is expanding to. And he actually had been contemplating making a business that literally would have been a competitor to Mater. So he had a lot of really interesting insights into the business that I didn't know about, and it was really cool learning from him. And then additionally, he literally just reached out to someone on LinkedIn who was a former employee of Mater and asked him a couple questions and told me what he learned, and that was incredibly helpful. So it's just all of these, seemingly small bits of information that we're able to get, and building relationships, and they just provide exponential growth and learning for all the members of the community.
Awesome. Well, thank you so much again for joining me, Kyle. I always enjoy these quarterly deep dives on our best quality idea for this quarter. If the TIP Mastermind community sounds interesting to you, you can check out our website and to learn more. That's theinvestorspodcast.com/mastermind. Also a link in the show notes. Or if you have questions, feel free to reach out to Kyle or I. My email is clay@theinvestorspodcast.com. Kyle's is kyle@theinvestorspodcast.com. So with that, we'll close out the episode there. Thanks so much for tuning in, and I hope to see everyone again next week.
EBITDA margin 68%, operating margin 63%, net margins of 58%, free cash flow margin 62%. I mean, it's hard to find businesses that can do that for a long period of time. And then on top of that, the thing that's really interesting is if you go back 10 years, all these margins have doubled. It's insane how much more money this business is just making every single year.